In this video, we're going to compare two popular high-yielding ETFs, which are the JP Morgan Equity Premium Income ETF, ticker JEPI, and the JP Morgan Nasdaq Equity Premium Income ETF, ticker JEPQ. Over the last year, JEPI's exploded in popularity among income investors, and not surprisingly, I've gotten a lot of requests from people who want to know more about JEPQ and basically how it compares with JEPI. I've covered JEPI several times on this channel in the past, but I haven't addressed this new alternative to it yet. Despite being launched by the same company and having similar ticker symbols, the two funds do have differences that are worth discussing. So in today's video, we're going to take a deep look into how this new fund compares to JEPI and which one might be the superior choice depending on your investment objectives. To give a little background, JEPI is an actively managed ETF that was launched on May 20th of 2020. The goal of this fund, according to their website, is to provide current income while maintaining prospect for capital appreciation. They describe this fund's portfolio as being defensive, and they employ a time-tested, bottom-up fundamental research process with stock selection based on JP Morgan's proprietary risk-adjusted stock rankings. JEPI generates income with written out-of-the-money S&P 500 index call options, and it pays monthly dividends. It's gotten a lot of attention recently over the last year as it was the 8th most popular ETF in 2022 by inflows, which is pretty rare for a high-yielding fund to achieve this much attention by the general public. Today, JEPI now has nearly $26 billion in assets. JEPQ was launched a year ago on March 31st, 2022, and it follows a little bit of a different strategy. The fund generates income through a combination of selling options and investing in US large-cap growth stocks, seeking to deliver a monthly income stream from associated option premiums and stock dividends. They use out-of-the-money call options, which are designed to generate income and give investors a portion of the upside. This fund also pays monthly dividends just like JEPI does. I'm assuming this ETF was launched after they saw how successful JEPI was, and I won't be surprised if they launch similar ETFs in the near future. Right now, this fund currently has over $3 billion worth of inflows, and it's still rapidly increasing. Even though JEPQ sounds similar to JEPI, they are fundamentally different in a number of ways. The first giveaway that they're different is in the title of JEPQ. JEPQ's primary focus is on tech stocks that are a part of the Nasdaq 100. If we look at this fund's largest holdings, we can see companies like Microsoft, Apple, Alphabet, and Nvidia. These top 5 holdings make up 34.34% of their portfolio as of May 30th, and they're some of the biggest companies in the index. If we look at JEPI's holdings, you can see it does hold some of the same stocks, but it also holds companies like Hershey, Pepsi, and Progressive. So ultimately, JEPQ is a lot more focused of a fund compared to JEPI, as it specifically targets larger technology companies. The second way JEPQ is different is that it holds much less holdings than JEPI. As of the making of this video, JEPI currently has 135 different holdings, whereas JEPQ only has 86 holdings. But both of these funds still hold those equity-linked notes though, which are debt instruments that don't pay a fixed interest rate, but instead are tied to the performance of an underlying equity. They're kind of an unusual holding, and I haven't really encountered them in any other ETF, closed-end fund, or really any other type of investment. According to Corporate Finance Institute, equity-linked notes include principal protection, leveraged employment, and higher total return potential. These notes make up roughly 11.85% of JEPQ's assets and 13.4% of JEPI's assets. So there really isn't much difference between how much ELNs make up both their portfolios. Another way JEPQ is different from JEPI is that it's less focused on avoiding volatility. If you recall in JEPI's fund description, it says the JP Morgan Equity Premium Income ETF seeks to deliver monthly distributable income and equity market exposure with less volatility. The way they look for less volatile stocks is by using their own analysis by picking stocks with a lower beta than the market. Beta is a measure of a stock's volatility in relation to the overall market. The market's considered to have a beta of 1, so if a stock has a beta that's greater than 1, then it's more volatile than the market. If it's less than 1, then the stock's share price is less volatile than the market on average. A stock with a beta that's greater than 1 is considered to be riskier, but it does have a greater potential for growth. You can find out a stock's beta on most financial websites by simply searching for the ticker symbol. It's a metric that probably more risk-averse investors pay attention to. But because JEPI targets stocks and investments that have lower betas, that does mean that its share price isn't supposed to swing as strong as the overall market. JEPQ, on the other hand, doesn't target investments by looking at their beta. Most of the holdings inside this ETF do have betas that are greater than 1. You can see, for example, that Nvidia has a beta of 1.77. This means its share price typically swings much more than the overall market does. It should go without saying that tech stocks on average are riskier than consumer staples, insurance, and food companies. But this does mean a couple things for these two funds. First, JEPQ will have much greater price swings compared to JEPI since it doesn't target steadier investments. Second, JEPQ's share price performance is probably going to match closely to a Nasdaq 100 index fund, whereas JEPI isn't going to perform as closely to the S&P 500. That's because there's fewer stocks in the Nasdaq 100 compared to the S&P 500, obviously. Let's compare the performance of both investments starting with their inception dates. Since the launch of JEPI, it's done really well by providing a total return of 42.32% in just a little under 3 years. To be fair though, this fund did launch while the markets were still in the middle of recovering from the pandemic, which did help a lot in terms of its share price appreciation. But regardless, up to this point, that does come out to roughly an average annual return of 12.38% with dividends being reinvested. With JEPQ, this fund's only been around for a year, so there hasn't been as much performance to look at yet. And unfortunately for JEPQ, this one did launch while the whole stock market was going down. But you can see that despite being in the red for the majority of the year, it's provided a total return of 8.23%. If we compare it to the S&P 500, we can see it's actually performed a lot better up to this point, which is encouraging. At the same time though, if we compare JEPQ with the Nasdaq 100 index fund, we can see that it has been a pretty close match between the two, but just in the last couple of weeks, the index fund really started pulling out ahead. Remember though, this is only after 1 year. I never really analyze a stock's overall performance or make an investment decision by just going off 1 year's worth of performance. Comparing both ETFs in terms of dividends, right now both funds offer yields that are way above average for most ETFs available. According to their website, JEPI currently offers a 30-day SEC yield of 9.79%, but JEPQ comes with a 30-day yield of 13.95%. So right now, JEPQ does come out on top with a higher yield, but looking at their dividend histories, the amount they pay can vary from month to month. The amount they pay each month depends on the covered calls that these funds write, so it can change depending on the month. It's rare that there's a huge swing between one month to another, but right now at least JEPQ appears to be offering the better dividend yield. We'll have to wait and see how this fund is going to perform in the years ahead to see if it'll be able to continue to offer this huge dividend yield that it currently does. With all things considered, what should our opinion be of both of these investments? JEPI has been a great pick for people who love covered call funds or just enjoy a good amount of monthly income. But what's made it stand out from other high-yielding funds is that up to this point, it's also delivered some pretty good share price growth. JEPQ, on the other hand, although it is a very young fund, it has done well up to this point. I don't like to invest in stocks or funds that don't have at least a couple years worth of performance that we can look at, but it appears to have a lot of potential. Both JEPI and JEPQ can be considered young ETFs, but JEPI has a long enough track record for me to feel comfortable being an investor in it. I am currently a shareholder of JEPI, but I've been holding off on potentially investing in JEPQ until I see how it performs under more market conditions. But if we compare JEPI with JEPQ in terms of performance over 1 year ago from today, JEPQ is currently beating JEPI. Ultimately, since we know that both funds focus on different types of holdings and they both have different strategies, if you're a fan of JEPI, I would view JEPQ as being something that could additionally complement your portfolio. I think it's an ETF that would be worth considering adding in addition to JEPI, not completely swapping out of JEPI and putting it into this new fund instead. If you don't have any hangups about investing in newer funds like I do, then up to this point, the JP Morgan Nasdaq Equity Premium Income ETF looks like something that could serve as a good addition to your JEPI position. If you currently don't own either and you're wondering which one might be the best pick, for the time being I'd have to stick with JEPI, but that's just my opinion, considering how much more diversified it is. With that being said, thank you all so much for watching today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.